Okay, let's get started. So if you have your worksheet, have that handy because I will be referencing it throughout the call. But if you don't want to use your worksheet, you just want to follow along with the slides, that's fine too. So thanks for joining me. Congratulations, by the way, because so many business owners don't realize how important their financials are. And there's another group of business owners who maybe realize they're important, but still don't take the time or make the commitment to understand them fully. And then they totally miss out on the opportunities to improve their numbers, improve your revenue, improve your gross profit, improve your net profit, improve the money that you're able to take out of the company as a business owner. So that is what today is all about. So let's get started. So we're going to talk about these 5 things. A more effective way to analyze your numbers, not just one number, how to avoid some risks, building your financial plan. So we want to build a 12-month projection or financial plan or budget, and the procedures that I think you should do every month to really get the leverage and the improvement that you're looking for. And then last, we'll talk about ways to improve those key numbers. And again, if you don't have the worksheet or the budget template, you can email office@tmhbusiness.com and Laura will get that out to you right away. Okay, so first slide. The reason I put this in here, I'm usually a very positive, optimistic person, but I learned a long time ago when I was studying change management, it's really hard for someone to change unless they're really connected or present to the negative impact of staying the same. So although it pains me to be negative for 30 seconds, we have to put these slides in here because we have to really make sure that you guys get present to what bad thing will happen if you don't improve your numbers, or what difficult things will continue if you don't work on your numbers or understand your numbers. So these are just a few things that I put in here. And I've heard these things right from the clients that we work with one-on-one. So number one, cash flow struggles. That's got to be the number one complaint. When people aren't really owning or mastering their financials, they're struggling with cash flow. They don't know if they have enough money to pay bills or enough money to pay payroll. They're not able to make decisions like, hiring a new person. They don't even know if they can afford to pay the current staff. Another problem that people have when they don't fully understand their numbers, they feel hopeless. They feel stressed out. They feel anxious. And it's not just you as a business owner. It could also be your partner or your spouse, your family, and your team. And this one is, if you're one of those people that's saying, oh no, my family doesn't know I'm stressed out, or my team doesn't know I'm stressed out, or my partner doesn't know I'm stressed out. I'm here to tell you, I'm sorry, but this is true. You are not as good a faker as you think you are. There's a lot of research out there proving that human beings have the innate ability to tell when you are not being authentic. So when you are putting on a happy face or trying to act positive or pretend that you don't have money worries, it doesn't work. People can still sense that from you. So I don't want you to fake it till you make it. I want you to actually understand your numbers and feel empowered and feel hopeful and reduce that anxiety and that stress. So that's kind of why we're doing this today. And then the third example was people feel like they're not able to set or achieve goals. And really, how can you set or achieve goals when you don't know your starting point? That would be kind of like saying you want to lose 10 pounds, but not knowing how much you weigh right now, right? And also, we really, really, really want to set great key performance indicators. It's just a fancy way of saying goals. We really want to be able to set good goals. You want to be able to give your staff goals, but they have to be based on something, and they should be based on these numbers. Okay, back to the positive. So what can we do? We are going to talk about your income statement, sometimes called a profit and loss. Those are the same thing. So we're going to talk about this mostly, and your budget is mostly based on this, and you'll see that in the following slides and on the template that you guys have. So let's just talk about the income statement for a moment. And like I said, maybe we'll change this heading for next time just so it says income statement or profit and loss. Some different bookkeeping programs call it something different. So on this income statement, can you see my mouse moving around, Laura? Where I'm kind of trying to show that I'm talking about the revenue right now. Yeah, okay. So, sorry, the sound is 5 seconds delayed, so Laura had to wait 5 seconds to tell me. So here, where you see your revenues, this could also be called income, okay? So it might say income, might say revenue. And basically this is going to be any sales. So this comes from anybody you invoice. All the amounts that you invoice get added together to show this total dollar amount for revenue or income, okay? And if you have different types of revenue or income, which we'll talk about later, those should be separated out here. Next is your cost of goods sold, or your COGS. So these are the costs that you have to incur to sell the thing that you're selling. You can also, sometimes you probably heard them referred to as variable costs. So as your sales increase, your COGS increase. As your sales decrease, your COGS decrease. So that's how you know that they're cost of goods sold and that they're variable. They go up and down with sales. So once you subtract your cost of goods sold from your revenue, you have what's called your gross profit. And if anyone is feeling like this is a really elementary review, that's okay. Stay with me. This will be, 5 seconds of the whole presentation. I just want to make sure everybody has the understanding of these statements before we move on. And then after gross profit, we have to pay all of our overhead expenses or our fixed expenses. So a lot of you, especially if you just started your business or you're just getting the very basic level of bookkeeping and accounting done, you won't have your expenses split into COGS and overhead expenses. You'll just have revenue, expenses, and net profit. But I want you to have, if you have any costs incurred whatsoever doing your sales, like you have to buy materials, or you have to buy retail products, or you have to pay a salesperson to sell the thing, or you have to pay your producers to produce the things that you sell. Those all have to go into cost of goods sold. And if you have those expenses down here in overhead expenses, that's not right. And it's not showing you one of the two levers that you really need to move in your business. So if you have expenses on your profit and loss statement or your income statement that are showing up down here, but they're actually variable costs that vary with sales, they are COGS expenses, and they need to be moved up here, which your accountant or bookkeeper can do for you, so that you can look at the gross profit every month along with your net profit. So now we're talking about overhead expenses or fixed expenses. Your accounting fees, for example, this I think is for 1 year. So these accounting fees are very reasonable. But yeah, so this just shows your accounting fees as an overhead expense, because obviously your accounting fees should not vary with sales. That would not be ethical. They're a fixed rate, they're a fixed fee, no matter how well you do as a company. Your accounting fees are your accounting fees, right? Advertising. So you're going to spend the amount that you spend on advertising regardless of sales. If you sell more, your advertising expense does not automatically go up. It doesn't vary with sales. If you're doing really well and you want to spend more on advertising, that's one thing, but it's not a variable expense because it's not tied to sales. Bad debt, depreciation, employee payroll tax, employee wages. Now these two things, these are for employees who are not producers or salespeople. These are like admin wages or wages that you pay that do not fluctuate with sales. Insurance, interest, rent, software, telephone, utilities. These are all really good examples of something you have to pay for regardless of whether your sales go up or down, okay? So again, we have income, cost of goods, and your gross profit is your revenue minus your cost of goods. Then we have all our overhead expenses, and our net income is our gross profit minus our overhead expenses, or our revenue minus our COGS minus our overhead expenses. Now, just doing a bit of quick math there in my head. Yeah, we're going to go to the next slide because I know I'm going to talk about this a lot more when we talk about our formulas here. But I just wanted to make sure that you guys understand how to read your income statement or your profit and loss. There's the income, again, should be broken into sub-accounts if you have different types of income. Your cost of goods, which are those variable expenses that go up when sales go up or go down when sales go down. And your overhead fixed expenses. So these are the expenses that don't vary. You have to pay these whether you sell anything or not. Okay, and your net profit is obviously what's left over after you pay for everything. Revenue minus expenses equals profit. Okay, so we're going to get into the difference in the different types of expenses a little bit more here. And your worksheet does not match the slides perfectly, but if you just want to jot down notes under the headings where you think that they are appropriate, then you can go back after and kind of make yourself an action item list. And also, if you have any questions, maybe write them down or put them in the comments, and then at the end, if the questions haven't been addressed already, we'll answer them then. So overhead versus COGS expenses. We already talked about this quite a bit in the previous slide, but COGS are those variable expenses, the things you have to pay for in order to be able to sell the product or service. So the employees you pay who produce the things, the materials that you have to buy, shipping on the materials that you have to buy, packaging costs of the things that you're selling, commissions, etc. So those things that are tied to, this is actually a pretty cute diagram. So the things that are tied to doing the sales, that you have to pay for to do the sales, those are your COGS. And again, the way we find your gross profit margin is by subtracting your COGS from your revenue. So you can see, hopefully already, that it's going to be really important for you to properly allocate your expenses based on whether they're a cost of goods sold or an overhead expense. Your overhead or your fixed expenses are all the other expenses that are not COGS. So like we saw in the previous statement there, your cell phone bill, your internet, your rent, your software, your admin wages, all the things that you have to pay for every month, regardless of whether you do 10,000 or 100,000. So the key here is that you really want to know where every dollar comes from and goes to. So on that income statement, in that revenue account, you want to know how you got to 500,000. Which invoices did you send out? Which bills did your clients pay you that added up to that revenue number? And that first income statement that we looked at was for a 12-month period, but I want you to look at your income statements every month. So it should be a lot easier for you to recall where the dollars are coming from and going to. Then I also want to make sure that you guys don't lump your income or expenses together, because this, again, sort of takes away a lever that you can move. So, for example, on that income statement here, if we just have sales revenue, that's not very helpful. If we sell 3 products, we should have 3 sub-accounts of revenue. You know, sales of product A, sales of product B, sales of product C. Because then we can tell how much of each thing we're selling. It's not just one lump sum, 500,000. Great, well that doesn't tell me how many of this I sold or how many of that I sold, right? Then also with your COGS, see how we just have one number here for cost of goods sold? That's not helpful if we have 3 products, because when we talked about a few minutes ago, gross profit being your revenue minus your cost of goods, we want to be able to calculate your gross profit for each different thing that you sell. And this is very, very important. If this is the only thing you take away from today's call, this will make it worth it. If you're not calculating the gross profit for each of your different types of income, you're really missing out on an opportunity for leverage. Because if you don't know which products have higher gross profit, let's say product A, B, or C, you don't know which one you should be trying to sell more of. Or you don't know that maybe product C needs its price increased. And you won't be able to figure those things out until you can track the gross profit separately. So if you want to track the gross profit separately, we just need to track the income separately and the COGS separately. Now, if you have no idea how to do that, that's okay. You just ask your bookkeeper or your accountant, and they will add those sub-accounts for you. Okay, the other thing I want you to avoid doing that has to do with lumping everything together, sometimes on your income statement you'll see something that says miscellaneous. I hope there's not one on here. Yes, there is. $5,000 of miscellaneous. Okay, so who wants to not know where $5,000 went? I don't think anybody. So Mika just made a noise. She's sleeping though. I don't think she wants to not know where the $5,000 is going. For those of you who don't know who Mika is, she's not our prisoner. She's a dog. She's our office dog. You should probably wake her up. She's getting loud. Now she's snoring. Sorry, guys. So miscellaneous, $5,000. I don't want to not know where that $5,000 is. If you ever see miscellaneous, or they sometimes call it ask my accountant or other, just ask your accountant or bookkeeper to put that in the account where it actually belongs. And they might not know because they can't read your mind and they don't run your business. So you have to tell them. So most software like QuickBooks Online, for example, if you see $5,000 miscellaneous expense, you can actually go into your report and click right on that number, and it will show you all the bills that went into that number, which is very handy because then you can say, oh, call your accountant and say, oh, I looked under the miscellaneous expenses and I noticed that this amount should actually be under software, this amount should actually go under advertising, and this amount should actually go under employee benefits or something like that, okay? And then the last thing we don't want you to do is lump your wages together. Because like I said, if you have people getting paid commission and you have to pay out the commission to do the sale, you want to put those amounts up in cost of goods sold, not down in salaries under the overhead expenses. Maybe just move her out to the other room. I wish I could show you guys on camera at the same time as showing you on screen. Mika's having a nightmare. We just have to wake her up. Okay, go outside, Mika. Aw, poor Mika. Okay, sorry guys. I was just getting the giggles and I wanted you to know why. So back to this. Don't lump things together. We want to make sure that we separate them and be really specific so that you know what each of them are. Because again, the whole point of this is that you need to know every dollar coming in and every dollar going out, what those are, so that you can improve those numbers, okay? And so I told you earlier, but I'll say it again. If you don't have your types of income separated or your types of COGS separated, just ask your accountant and they can add a sub-account. Why? So I did address this earlier, but I want to say it again. To calculate gross profit per account or sub-account. So we really want you to know, if you have 3 different products, what the gross profit margin is on each of the 3 products. Because once we know that, we can make all sorts of changes. Some of my clients will altogether stop selling one of them because they'll realize that that one product or service was actually losing them money. Some people will increase their price so that their gross profit margin is better on that item. Some people will find a different way to make a product or a different way to deliver a service to get their costs down, which also increases gross profit margin. But I would say that the most powerful change that people make once they discover their gross profit per item or category or account is they focus more of their efforts on selling more of the higher profit margin items. And they altogether stop promoting the lower profit margin items, or they raise the prices. Because obviously, if we're selling more of our higher margin things, then our overall profit margins will be higher, okay? And I know that sounded just a very normal tone of voice and maybe just like one more thing you might hear in a presentation, but that was probably the most important thing I've said today. You have to figure out the gross profit on your different products and services and sell more of the higher profit margin items, okay? Don't just recklessly delete or get rid of all the products that you sell except for the highest margin one. Make sure you do your research. Make sure that there is a market for that higher margin item before you think about stop doing the other things, okay? The other thing is, before you stop selling something, you really want to take a look at your marketing plan and really examine, whether your products fit with your strategic objectives or not. There's a whole lot more that goes into starting or stopping a product or service, but this is definitely a beginning point for you. If something is like very low margin, and when I say very low margin, I mean if something is such low margin that if you only sold that thing, you wouldn't be able to pay your overhead expenses, you really want to take a look at why you're selling it. Now, I just want to say a couple things here, a little caveat here. If you have a product that you sell and it's like we have a product, it's a really, really cheap online course, it's like $18, but it's like a brilliant course. If we sell only that, we would probably have to go out of business. But when we sell that, it is so affordable. There's a very low barrier for people purchasing it. And once they get that course and they see how brilliant we are and how much we can teach them, it really lowers it really increases the conversion rate of them buying other courses. So if you guys have something like that, where you sort of have like a loss leader, something that's out there at a low margin, but it leads to other sales, you also don't want to get rid of that, okay? Yeah, that's just sort of one example of I just wanted you guys to know that I'm not saying, no matter what, if it's a low margin, get rid of it. You definitely have some thinking to do about it. Okay, let's talk about gross profit and net profit. So gross profit, as I said when I was talking about the income statement, is your income or your revenue minus your COGS. So when we get that gross profit number, let's go back to this sheet for a second here. When we take our revenue, 500,000. Sorry, I'm just going to do it on my calculator. Minus our COGS, which are 150. We get gross profit of 350,000, right? Now that's just a number, it's a number of dollars, but I want you to convert it into a gross profit margin. So all you do is divide 350,000 by 500,000. Now you have a percentage, 0.7. So you know how to get a percentage, I'm sure, move the decimal 2 places. So your gross profit margin is 70%. That's a fairly good gross profit margin for most industries. But if you can charge more or spend less, you can have an even higher profit margin. And remember, we have to make sure that the gross profit margin is high enough that it can pay for all of the overhead expenses and still have some net income left, okay? So then, again, I'm going to go back to this. Once you know your gross profit overall, you also want to make sure that you can figure out your gross profit on each item. And when we get to our budget spreadsheet, here it is. Don't look, sorry, I'm confusing you. I'll bring up the other spreadsheet's linked in here, right, when I get to that slide? Yeah, I'm sure it is. Okay, so net profit now. So your net profit is what's left at the very bottom, your net income or your net profit. So the way to increase your net income or your net profit is to decrease any overhead expenses, like if you can get a better deal for your cell phones, or if you can find cheaper office rent somewhere, or if you can spend less on office supplies, or if you can spend less on your admin wages. Those monthly costs that you have to pay no matter what, if you can find any way to decrease those, you should do that. Or you can increase your revenue, okay? Increasing your sales always increases your margins. Well, that said, if you increase your sales with something that has a lower gross profit margin, that is not going to increase your gross profit margin. The other way you can increase your net profit is by default once you improve your gross profit. So when we were talking about selling more of your higher gross profit margin items, just by doing that, you'll have more gross profit. And if you have the same overhead expenses, you'll obviously have more net profit. So I always tell people that a lot of people like to ask me, well, what's average? What's good? What's a good profit margin? And I never tell them, because I think that when you look up your industry standard gross profit margin, not only is it usually, in my opinion, inaccurate because it lumps a bunch of different types of businesses together and calls them one industry, but I feel like it really sets the bar low. So if you look up, the average profit margin for, I can't even think of an example right now. Retail or manufacturing. First of all, it's not going to be specific to your business type, it's just the whole industry, but it's also going to be pretty low. You have to remember that 96% of all businesses fail in 10 years. 96%. So do you really want to be average? No, you don't, because if you're average, you're going to fail. So I don't even recommend looking at those industry standard profit margins. I recommend that when you make your budget and you plan out your revenue, your COGS, your gross profit, your overhead expenses, and your net profit, you have to make sure that that net profit, what you're left with at the very end, is worth all of your hard work, all of the sacrifice that you put in as a business owner, and all of your effort. If it's not, you either need to raise your prices or sell more, somehow increase your revenue, or decrease your expenses. Because if you're not making the money that you want to make out of the business, then what's the point? It's a lot riskier being a business owner than it is being an employee. So if you're not making the money that you want, if you're not getting the net profit that you want, you might as well go get a job where you'll be safe and another business owner will take care of you. Okay, so just remember that when we're making our budget. You want to make sure that these numbers make you so happy that it makes everything worth it. Okay, so when we looked at the income statement here, you notice that I took the gross profit, 350, and divided it by the revenue to come up with 70%. Because when you start to look at your numbers differently, instead of just looking at the income, the expenses, and the profit, if you start to look at, let's say, your gross profit as a percentage of revenue, so now you know the gross profit for that income statement was 70%. Okay, so last year, ending December 31st, our gross profit was 70%. So now you know on average for the last year, your gross profit margin is 70%. So what can you do with that? Well, I would break up that 12-month income statement into 12 income statements so that I could look at each month separately. And I would look at the gross profit in each month divided by the revenue in each month to see what the gross profit margin was that month. Because some months you might have way higher gross profit margin, some months might have way lower. And then you need to investigate why. Why was our margin higher some months and lower some months? It can be anything from, actually I had this happen last week. A client who assumed that they knew all of their profit margins actually started going through every single product and every single supplier and were quite dismayed to find out that no, a lot of their things were not selling with a gross profit margin of, 50% or higher. Some of them were as low as 11%. And that's a big danger in business, especially when you get bigger and you start to assume things. We assume that all of our things are selling at a certain margin, but we can't be sure of that until we check. So the easiest way to check, instead of actually looking through every single product, is to look at your income statement or your profit and loss and divide your gross profit margin by your revenue. And as long as you're hitting your gross profit margin goal, then it's pretty safe to assume that all of your products or services are marked at that profit margin. Another way you should look at them, one more thing I want to say about this, about the percentage of revenue. You can also look at salaries as a percentage of revenue. So here we have employee wages, $100,000 on $500,000 of revenue. So our overhead employee wages are 20%. Okay, so you might set a goal for next year, say, you know what, I always want wages to be 20% or less of revenue. And then you can make that a goal in your budget. You can give your office manager that as a goal, or you can give that to your team leaders to make sure that they have their staff performing at a level that brings in 5 times the revenue that we pay them. And you can do this with any of these numbers. Advertising is sort of a classic one. You want to spend 1 to 5% of your revenue on advertising usually. I mean, the closer to zero, the better. And nowadays that's getting a lot easier to do. But if you divide 25,000 by 500,000, I believe that's 5%. And so you can look, okay, well this year our advertising was 5% of revenue, but last year maybe it was 6% or 10%. So then you can see that advertising is decreasing as a percentage of revenue. And the reason I want you to look at things as a percentage of revenue is because then once you have them as percentages, you are comparing apples to apples. Whereas if you're just looking at 25,000 on 500,000, or let's say 31,000 on 600,000, it's very hard at a glance to know which one's better. But if you divide those by the revenue, then you have 2 percentages to compare. It makes a lot more sense. Then my second favorite way to compare numbers is to other time periods. So look at your profit and loss statement for September last month, and then look at your profit and loss statement for September 2018. And look at those numbers as a percentage of your revenue too. Don't just look at the dollar amounts. Additionally, you can look at September compared to August, or compared to August and July and June. And as you'll see in our budget that we're going to go over soon here, we built that right into the template. So you can look at last month, you can look at year to date. Do we have last year in there? Not sure. Some of our clients like to add last year's number in there too. And then third, and I already mentioned this, I want you to do much better than industry standards. So don't set your bar at industry standards, set it above. Okay, building a budget. So I seriously just yawned. I was about to tell you that some people think budgeting is boring. It's pretty funny. We're gonna have to figure out a way to get my face on here after this, because then we can show Mika. So building budget. So you must build a budget every year. Some clients, especially in industries that change very quickly, like technology businesses and things like that, or businesses that are heavily dependent on technology, because technology changes so quickly, they might just budget 3 to 6 months at a time. But I haven't met any business owners, well, maybe one in the last 6 months, who needed to do this. Mostly, I recommend that you budget for the whole year. And the way that you do it is you plan 3 to 6 months before your fiscal year starts. You plan for that fiscal year. So to create your budget, you should gather the last 12 months income statements and then the last year income statement. And every time I say income statement, I hope you know that it's either an income statement or profit and loss. They're the same thing. And what else do you want to look at? You know, if you had a budget last year, grab that too. And then make sure that you involve the right people. So if you have somebody who's in charge of making sure you hit your sales goals, they should be involved. If you have somebody in charge of helping you minimize expenses, they should be involved. And then once your budget's created, you want to do everything in your power to make sure that you stay on budget and hit your goals. So this is what a budget's going to look like. Yes, it does have last year in here. So don't be overwhelmed. We're gonna start with an empty budget in a second, and I'll show you how to build this. But this is what it looks like when it's totally filled in. So the first column has January last year. The second column has January this year, what actually happened. And then the next one is February last year, and then what actually happened in February. And after 2 months, we start to add 2 more columns, year to date, what the budget was, and year to date actual. So this helps you in several ways. One, if you were just tracking the months, so goal for January, actual, goal for February, actual. If you had a good January but a bad February, you wouldn't know if you were on track for the year. So we like to track year-to-date numbers as well after two or more months. And you can see here we plan out goals for sales for each of the income accounts, and we plan out the expenses. I'm just going to bring up this other template here because it's better. Okay, so if your fiscal year starts in January, you can just use the template exactly how it came to you, but if it starts in a different month, you just want to rearrange the month so that it starts on the same month that your fiscal year starts and ends on the last month of your fiscal year, okay? So in January, our goal for product A is to sell 15,000. Our goal for product B is to sell 20,000 for a total income goal of 35,000, okay? Now, if I was smart, I would have deleted these before. Sorry, guys. So let's pretend that January just ended. Okay, let's say it's February 15th and you just got your financial statements from your accountant. You're going to take those statements and you're going to look on there and say, how much revenue did I do of product A? Okay, I did 16,000. Great, you beat your goal, okay? And you want to do this with every number every month. Now, second, how much did we sell of product B? And again, we're getting these actual numbers from your income statements, okay? And then you see, oh, we missed our goal by 1,000. Now that's not very much, but you still missed your goal. So you really want to ask yourself, why didn't we hit this? And when you ask yourself that question, this is where all the leverage comes from. When you don't hit a goal and you ask why, you go and find the area of your business that you need to improve. This is exactly how it happens. So then your total income, which is just these two added together, is 35,000. So you actually did hit your sales goal overall, okay? But here's where the difference will happen. If you sold more of product A and it has like a higher cost of goods sold attached to it, and you sold less of product B and it has a higher gross profit margin because less COGS amounts, your COGS for the month are down, so that means your gross profit will be up because gross profit is your income minus your COGS. Okay, so look at this. Our gross profit goal was 11.6 and our actual was 14. So that means we sold more higher gross profit margin than we thought that we would. So our overall gross profit margin, again, is gross profit divided by income. So our margin was 40% instead of 33. So that's great. That's a great month. You want to ask yourself why. Why did we have a higher margin? It's probably because you sold more of a higher margin item. And then, of course, on your income statement, you also want to grab your overhead expenses. So how much was rent? We're never usually wrong about rent, right? How much was the internet? The bill is usually the same. Insurance, pretty sure you know what your insurance is. Let's say you lease a vehicle. Salaries. Now let's say you had some overtime in there, so your salaries were over. And then, just like above, we sum up the expenses for our total expenses. So for the month, our overhead expenses were supposed to be 11,200, but they actually came in at 13,200. So look at the difference here. Our gross profit was over budget, which is great, but then our total overhead expenses were over budget, which is not great. So our net profit is our income minus our COGS minus our overhead expenses. Interesting. Sorry, this is different every time I do it. So we hit our income goal. We were under on our COGS, which means we were over on our gross profit. And we were a little bit over on our total expenses, which left us with $800 net profit instead of $400. By the way, these are not great numbers. If these are your numbers, do something different or stop having this business because this is not enough gross profit. First of all, $800 is not enough, but 2.29% is also incredibly, incredibly low. So you really want to set your aim higher here. And again, there are several ways to make this number at the bottom better, okay? Increase your income, decrease your cost of goods, increase your gross profit, or decrease your overhead expenses, okay? Now, when they got the worksheet, the budget, it had both tabs on it, right? There's a tab for the completed budget on the second tab. Okay, if you did not get this one and you want a copy of this, just so you can kind of follow our math, you can email office@tmhbusiness.com and she'll send that over to you. But you definitely would have gotten this empty one that you can fill your numbers in for. And if you guys have any questions at the end here, make sure you put them up there and we'll answer them for you. Okay, I feel like that was a lot. So luckily for you, this video is going to stay on Facebook and you can rewind it and watch it over again if you need to. Or like I said, if you have questions at the end, let us know. Okay, now that you have created your budget, I know you're not done yet, but you're going to do it later. Once you have that budget, here are the things I want you to do every month to increase your leverage, increase your profit. So first of all, like we just talked about, compare your profit and loss or income statement with your budget. So this is where you take what actually happened in your profit and loss and you enter it line by line and you compare. Did I hit it? Why or why not? Did I hit it? Why or why not? Did I hit it? Why or why not? That's where all of your power is going to come from. Okay, so make sure that you do that. Profit and loss statement, compare with budget. Every month, as soon as possible, as soon as your bookkeeper account gets your books reconciled, do this. Number two, let me see how much time we have here. Okay, number two, cash flow statement, balance sheet, and accounts receivable. So I'm going to go over these ones pretty fast. Cash flow statement, you have to ask your bookkeeper account before you pull this, but sometimes these won't be accurate for you until the year end. This really shows all the cash that flows in and all the cash that flows out from the different types of activities in your business. So depending on the way that your business works, your income statement might be more than enough information for you. But ask your accountant or bookkeeper if they think you should also be looking at your cash flow statement, because if your cash flow statement is much different than your income statement, it's probably a good idea to look at it as well. But only if they're making the entries every month that they need to make it accurate. Second, your balance sheet. So your balance sheet is a snapshot of your assets and your liabilities. So what you own and what you owe. This is good to keep an eye on, especially if you have do a lot of asset purchases, or you have a building, a mortgage payment every month, or you're paying down debts like business loans or financing vehicles, because when you pay down debt or you acquire assets, these things are not going to show up on your income statement. So on this budget here, they're not going to show up in there because those are balance sheet items. So that's when it becomes important to also look at your balance sheet. Again, ask your bookkeeper accountant if they think it's pertinent for you to look at your balance sheet in addition to your income statement. They may say no and save you some time. Last, your accounts receivable report. So you always, every single month, somebody, it should be their job to get your accounts receivable down to zero, or at least down to 2% or less of revenue, okay? So accounts receivable, again, it's just a report that you pull that shows the people that owe you money and how much they owe you. So you need to make sure. Also, if you seem to be having a problem with accounts receivable, you definitely need to work on your procedures in terms of client expectations, pricing, collecting. You should never have AR outstanding. Yeah, there's a better way to run the business if you're having problems with this. So, but that's going to be a whole nother live class. So now that you've done these things, I just want you to really acknowledge how much power you'll have to make changes. Now, I know you haven't done all these things yet. You've just been listening to me yammer on, but once you do them, you will have a lot of power to make changes. These numbers, as you saw when we went through, one at a time on that income statement here, when you look at your goal versus what actually happened, and you ask, did I hit it? Why or why not? Those questions really give you the answers of the levers that you need to move to improve the profit. So here's a few other things I want you to know. I want to tell you how to do them so that you can improve your gross profit and your net profit. Okay, so make your marketing more effective. The easiest way to do that is, sorry, this worksheet is really throwing me off. I think I have it in the wrong order here. So how to improve your numbers, more effective marketing, tracking leads and clients. So a lot of you, if you're doing online advertising, you have really, really great data on that. It shows, how many people view it, how many people click it, how many people go through to the landing page, all that. But if you're not doing strictly online advertising, which a lot of us aren't, and you're getting, new leads from referrals or people who walk by and see your sign, or people who maybe see a billboard that you advertised on or heard about you on the radio, any of those things, they're not being tracked automatically online, so you have to track manually. So every single lead, every single inquiry that is made into your business, make sure you ask them how they heard about you and if they've seen or heard about you anywhere else. Now, I recommend you ask that second question because most of us on average, it takes 16 impressions of a brand for us to take an action towards purchasing. So if somebody comes to you, it's probably not that they only saw your sign once. They might have seen your sign, they might have read your Google reviews, they might have heard about you from a friend. There may be a lot more than just one thing that had them come in. So hopefully your software is tracking for all your clients that do business with you, it's tracking how they heard about you. If it's not, you definitely should find out if it's capable. Probably one of the most important questions in your entire business. But you need to track this for leads and clients. So if your software program is not tracking this for clients, then you're going to have to track that manually as well. The reason we need to track for leads and clients how they heard about us is because if we don't track both of those things, we're not going to be able to calculate the cost per lead. So how much we're paying to get one lead. For example, if we spend $1,000 on Facebook and we get 1,000 leads, it's $1 per lead. Okay. Also, cost per customer. So how much we're having to pay for that type of advertising to acquire a new customer. If you spend $1,000 on Facebook and you get 100 new customers, you're paying $10 per customer. Conversion rate. So let's say Facebook again. Let's say you get 100 leads from Facebook, but only 10 of them turn into customers. That is 10% conversion rate. I don't think it's a good idea to spend more money getting more leads if you're only converting 10% of your leads. You need to increase the conversion rate of those leads before you spend more money getting more leads. Or you need to advertise somewhere else to get a better quality of lead that is more likely to convert. Or you need to change your message because if you're getting a bunch of leads that don't convert, you may be getting those leads with something that is different encounter when they get to the page. So if you put out an offer and you get a bunch of leads, but then none of them convert, that's sort of a sign that your offer is misleading or it doesn't match what they come in contact with when they get in there. Now this is a whole entire another class that we'll do next month or the month after. But there is so much money to be made in analyzing your marketing. So you need to do this. Track where your leads are coming from, track where your clients are coming from. And last, return on investment. So unless you're tracking this, we can't tell, if you spent $1,000 on Facebook, what your return on investment was. Then once you know those numbers for each, you can increase them by stopping spending money on the ones that are really low and spending more money on the ones that actually work. And the great news is usually nowadays, if you're doing a really, really good job with Google reviews and taking really good care of your existing clients and you have a great website, pretty much you can get a lot of new leads for free, because 96% of people are looking online and reading reviews before they make purchase decisions. So having lots of Google reviews will help you there. Doing a great job taking care of your current clients will get you more referrals. There's all sorts of things. We'll talk about that in the marketing live class, but you can improve these numbers often for free. Then survey your ideal clients. So instead of guessing what your ideal clients want, survey them. Ask them all sorts of questions so that you can make your marketing more accurate. If you send out good surveys, you should be able to tell them, you should be able to find out from your ideal clients what to say and where to say it to get more people like them. key performance indicators. So you really want to have key performance indicators, KPIs, or just goals for each of your staff members. Make sure that those goals are measurable and you can track them every month. And if your staff hits their goals, you will hit your goals, which means you'll hit your budget. And then last, make sure you visually track your goals. So if you've got a team of 50 people and they have no idea what their goals are, or they only hear about their goals once a month, your results will be one thing. But if you visually track it, in our experience, the very first month after you start visually tracking goals, whether you have them up on a board in the lunchroom or you have them in their offices where people can see it, you'll get an increase in performance of 10% the very first month. So make sure that you're tracking those goals somewhere that everybody can see them. Okay. If you enjoyed today's class, please leave us a Google review. We love Google reviews. We really appreciate you guys. You can just Google TMH Business Coaching. You'll find us there. Leave a review with comments. We would appreciate it so much. And if you don't think we deserve 5 stars, please tell us why, because we are always looking for feedback. I really think that's one of the keys to success, is being open to feedback. So if you guys have any feedback, please share it with office@tmhbusiness.com. And I hope that really helped you guys. I'm just gonna check here if we have any questions. No? Okay, awesome. So this will be up on Facebook for you guys to watch again if you have any questions. And again, if you wanted the worksheet or a copy of that spreadsheet I talked about, you can email office@tmhbusiness.com. I know your time is really precious, so I really appreciate you guys joining us. Thanks so much and have a great day.